and markets do witness good buying interest today, but can't forget the fact that we have been in a range since quite a long time now, and hence we require a fundamental analysis from an expert to understand the long-term picture of the market. For the same, we have Siddharth Vora, Head Quant Investment Strategy and Fund Manager, PL Asset Management. Siddharth, good afternoon. Thank you so much for giving your time to ET Now. Mansi this side. My first question to you, of course, on the markets, as we clearly see that we have been stuck in a range where patience is the key amid lack of triggers and direction. What's your short-term, medium-term as well as long-term view on the markets at present?
Sure. So I think, just to put things in perspective on the market, we need to understand from a short-term basis, we lack any positive triggers. Most of the positive triggers seem to be priced in, whether it's India's stable macro, whether it's reducing food inflation, whether it's the interest rate cuts, the budget impact around taxation, or it is the improving monsoon outlook and the rural recovery and rural demand recovery. I think a lot of the short-term positives seems to be priced in. The valuations are not cheap, neither for the mid and small caps nor for large caps. At best, large caps are fair. None of the asset market caps are cheap at this point of time, and therefore we don't expect any runaway rally or a major up move. So because of valuation, there is limited sort of headroom for the markets to, grow significantly from here. At the same time, we need to understand that global cues will keep us under check, whether it's around trade tariffs, whether it's around crude, whether it's around foreign flows or geopolitical stress around different parts of the world. So it is going to be a range-bound market. But the good thing here is after being a sell on rise market for 10 months, we are now a buy on dip market.
Sure.
So there has been a change in sentiment. The market internals are much more stable now as opposed to the previous 12 months. So that's the only good part about it.
All right, Siddharth, hi, this is Kavita asking you the question now. So definitely no runaway rally expected, but having said that, I really want to understand what are your risk management or risk mitigating strategies, where what kind of exposure in terms of sectors are you taking, because negative surprises are always expected, that's how the market runs. So what are your risk management strategies so far?
So I think the last couple of months have been very good for us in terms of performance as well, and in terms of risk management and drawdowns. So the way we've constructed our portfolio, I think it's 40% large caps, 40% mid caps, 10% small caps, and roughly 10% cash. That's been the construct for a while now. Within that, we have a slight tilt towards quality and low volatility and dividend. These are the three factors that have a slightly higher tilt in our multi-factor construct. In terms of sectors, we were roughly 45% in financials. We're down to roughly 33-34% now. We've exited private banks. We still continue to own insurance, AMC stocks, capital markets, and a couple of select lenders as well. We've trimmed our position from private banks and a couple of lenders. Other than financials, the second major overweight has been materials, comprises of metals, mining, chemicals, agrochem. That is roughly 18-20% of our portfolio. Industrials, roughly 10%, IT, 8%, and consumption across the different pockets from discretionary staples, automobiles, real estate. That's roughly 15% of the portfolio.
Right.
So, defensive sector tilt, defensive style tilt, and slightly moderate sort of market cap tilt with some cash. That's the way we've constructed the portfolio to navigate the choppiness in the market.
Right. Point well taken. Hi, Ankur, this side. You just mentioned about exiting private banks space. I want to know the reason behind it. Of course, the large part of your portfolio still remains financials, but any reason for exiting private banks, and are you more bullish on PSU side?
So no, I think from a financials perspective, we're finding a little more comfort on capital markets, on insurance, on asset management companies, and slightly differentiated lenders rather than private banks, given bulk of the triggers for private banks have already sort of played out. And, with the rate cut as well, I think the cycle to see improvement in NIMs, to see improvement in credit growth, it will be a long cycle. And we've entered private banks in December, Jan. We've experienced a good sort of rally. And now we feel that, our models feel that the portfolio needs to be turned over. We need to book profits here and move to the next segment of the market to capture the next set of returns. And purely from a valuation, incremental growth, momentum, and risk perspective, we find better opportunities in other sectors.
All right, Mr. Vora, thank you so much for joining at this hour and sharing your views. With this, it's time to take a very quick break, but don't go away. News and updates will